All right. Today is Sunday, August 15th. This is a recap for the stock market activities last week and an outlook for the week to come. Before we start, make sure you press the like button, subscribe, and leave a comment. I don't care what comment it is. For all I care, you can write what you ate for breakfast this morning. Eggs, sunny side up. That'll do. You guys know how algorithms work. And while you're at it, make sure you disable your ad block or whitelist the page and watch whatever garbage they show you for about 3 seconds or so and then skip. That way your views are counted. Otherwise, may all your trades end up with you holding the bag. And with that positive note, ladies and gentlemen, in focus tonight, we're going to talk about the big bomb, the nuclear bomb we got on Friday, the crash in the Consumer Sentiment Index. We only seen this kind of crash twice before. Once prior to the 2009 crash, and the second time was during the 2020 crash, the COVID-19 crash. And then we're going to talk about a slip from a certain Fed president who told the truth, believe it or not. And I have a theory here that this president actually watches this channel, and he's going to give us a call live on air. But first, the Consumer Sentiment Index bomb, the nuclear bomb.
You know, Carl, the big question is how much is this variant going to impact consumer confidence? And now we know the answer, a lot. 70.2. This is a miss times 10. We're looking for a number on University of Michigan, August preliminary sentiment, closer to last month's final number at 81.2. Humongous miss.
And notice how they talk about Delta as the reason behind the drop in the Consumer Sentiment Index. But few talked about the impact of inflation or perhaps stagflation on the consumer sentiment. This is the historic drop. The Consumer Sentiment Index is now reading at the lowest level since 2011, and the Economic Outlook Index dropped off the face of the earth, erasing pretty much all of the gains since the pandemic lows. This is nothing short of a disaster, and it exposes the true nature, the facade of this economy, that it is a zombified economy hooked up on drugs, on coke, out of the Federal Reserve. And this is the only reason this economy and the market is being propped up higher. But at the smallest shake, at the smallest scare, the whole facade comes down crashing. And we all know the moment the Fed decides to tighten the monetary policy and reducing the supply of cocaine to the market, this market will suffer a withdrawal and it will crash like you have never seen before. Even the Fed itself says we're going to give you advance warning before we start tapering. Why do we need an advance warning if tapering is not a big deal? And if this market has legs to stand on? We don't need an advance warning. We need an advance warning if the show is about to end. We're heading into dire times here, but some have their blindfolds on, being completely delusional and believing that this market, this Ponzi scheme market, will continue to go higher and higher and higher forever and ever and ever. Watch out here. This is from the same Consumer Sentiment Index out of the University of Michigan. We talked about the zombified consumer losing their minds, stampeding Naruto style heads first, asking questions later, after the fact, buying garbage homes above the asking price, buying used vehicles with over 100,000 miles on them, paying above the sticker price for a car, paying for used cars, paying more for used cars than they were new. Absolute insanity. The consumer has been stripped out of rationale 1,000,000%. But perhaps we have reached a tipping point here where the consumer has awakened from the zombified state. When consumers are asked, is this a good time to buy a house or a vehicle? Look at the drop. Massive drop. The lowest reading since 1980s. This is historic. We have never seen the consumer sentiment drop by this magnitude so fast and so rapidly. When consumers are asked, is it a good time to buy durable goods? We have now erased all of the gains since the pandemic lows, and we are reading at the same lows, pretty much the same, of the pandemic and of the crash of 2009. Of course, they blame this on Delta. But the real answer is inflation is growing out of control, out of whack. Prices are surging, and now the consumer finally is saying we cannot keep up with this. This is insanity. This is not a good time to buy anything. Of course, that leads to the question, have we already entered the stage of stagflation in the economy? Looking at the facts, combining the producer price index, the highest reading on record, and then the consumer sentiment index, one of the largest drops in history. You combine the facts, and we are indeed in stagflation. Now, the real test is, and you have to pay attention here, you have to differentiate between sentiment and actions. Consumers might feel that this is not a good time to buy a vehicle, but they need a vehicle anyways, so they're going to stampede and pay over the sticker price for a garbage vehicle. So you have to differentiate between the sentiment and the action. And as we get more data, we will see if this sentiment is being translated into action by the consumer. Here's more from the report. Going all the way back to the 1960s. This is one of the sharpest drops in history in the Consumer Sentiment Index. We have erased half of the gains since the pandemic lows. And if this trajectory continues, the consumer sentiment will drop to levels we have not seen since the 2009 crash and back during the great stagflation of the 1970s. This is the current economic conditions index. We have now erased pretty much the entire gains since the pre-pandemic lows. The consumer sentiment regarding the economic conditions have dropped to alarming levels. And most importantly, when the consumer is asked about their expectations for prices in the next year, this is the largest surge, the largest in history since the 1970s. And we are now reading well above 4%, almost 5%, the highest reading since before the crash of 2009. They say deflation will happen. Inflation is transitory. Of course it's going to be transitory, because it will lead to crashing the economy, you geniuses. Here are the results. Month over month, the consumer sentiment is down 13.5%. Year over year, down 5.3%. Folks, we're talking about year over year. We had a pandemic last year and a lot of uncertainty prior to the vaccines. We are now reading a negative reading year over year in the Consumer Sentiment Index. Absolute disaster. What about the current economic conditions? Month over month down almost 8%. Year over year down 6%. Unbelievable. The index of consumer expectations down 17.5% month over month and down 4.8% year over year. This is nothing short of a disaster, and you cannot just blame Delta alone. This is lack of faith in the Fed and the federal government. The Fed says inflation is transitory, but we continue to see prices going higher and higher and higher every day. And we talked about the bullshit explanation of what transitory means by Federal Jerome Chairman Powell, whatever the hell his name is, saying that prices are not going to go down. Oh, that's not what we mean by transitory. Prices will continue to go higher and they will not reverse down. We're talking about the pace of increase. Maybe a year from now, 2 years from now, the pace of increase will slow down. But we as consumers are left with the price increase. Meanwhile, our wages did not go higher. This is inflation to us. This is a hidden tax to us. This is a destruction of the consumer purchasing power and a destruction of the standard of living in this country. When my rent goes higher by 25% and next year it goes higher by 5%, Powell says, aha, you see, inflation was transitory, but I am stuck with paying that extra 25% from last year. And guess what? My wages only went up higher by 2 to 3%. Americans are extremely worried about the Delta variant and the spike in COVID-19 cases. A key survey of consumer confidence plunged in August below where it was in April 2020, when the first COVID-19 outbreak slammed the brakes on the U.S. economy. The University of Michigan said in its influential Consumer Sentiment Index plunged 13.5% from July to August and hit a level of 70.2. That is the most bearish reading for this measure since December of 2011. The drop was so precipitous since last month that the University of Michigan has recorded only 6 bigger monthly drops in the index nearly 50 years history, including a more than 19% plunge in April 2020. We know what happened back then, an 18% drop in October 2008. We also know what happened back then during the height of the Great Recession and global financial crisis. If this is not a wake-up call to all market participants, I don't know what is. In addition to Delta fears and inflation concerns, I bet that consumers are also looking to the fiscal side and the insanity of spending on steroids. We now have about $3.5 trillion in budget deficit. Who's going to pay for this? How are we going to pay for this? And why is the government adding trillions and trillions and trillions of dollars in debt and expanding the budget deficit? Why? That's going to bite us in the ass sooner or later. The consumer is starting to wake up to the facts here, that we are reaching the end of the game. Remember the game? And the future will look dire. This is an economy, and this is a market hooked up on steroids, artificially being pumped by the Fed and the stimmies from the fiscal side. Once that support is lifted, the economy and the market have no legs to stand on at all. And here's from Richard Curtin, the author of the Sentiment Index Survey.
Let's talk to the man now who leads the team putting together this data, Richard Curtin. Richard, thank you very much indeed for joining us. Is that what I'm seeing here? Is this a Delta effect?
It is, and but thanks for having me back. And I think we should look at this set of data as something that consumers delivered on Friday the 19th. The sentiment index in early August recorded the third largest monthly decline in nearly a half century. It was down 13.5% from last month. And it pushed the index to below where it was in April 2020, which was our low for that recession. And, by comparison, there was the other two larger declines were first in April 2020 when the shutdown took effect. That was 19%. And then during the depths of the Great Recession, we recorded an 18% decline. Now, these losses covered all income, education, and regions of the country, including all age groups, and covered all aspects of consumers'
So, Richard,
views.
if sentiment is waning, what is that going to mean for their tolerance to price increases and the inflation side of the equation?
Well, Guy mentioned that we had a little change in the expectations of year ahead and 5-year inflation. And actually, they've been really unchanged for since May. They've been at these high levels. And, and I think, that evidence doesn't bear on the case of whether the transient nature is there or not. But consumers in August, as they did in the several months prior to that, have complained about high prices for homes, vehicles, large household durables, and this has caused them to adopt negative attitudes towards spending. Now, I think, this will help curb some inflation in product pricing because they're not going to buy, and they've already turned down home sales and vehicle sales. Of course, vehicle sales had other problems. So I think it will help, but I think it's too early to tell.
Now, he highlights, better than others, the role of inflation on consumer sentiment. But he also raises the question, if consumer sentiment drops and the consumer is saying we're not going to buy used vehicles anymore, actually they did not say that. They said it is a bad time of buying vehicles and buying homes. The question is, will they follow up by action and boycott buying goods altogether? If they do, then the demand side of the equation will go down. And the assumption is prices will go down because we will have the demand to supply dynamics being adjusted for the first time in favor of supply since the beginning of the pandemic. Here's the problem. For now, we have to assume that this will be stagflation because we have no indicator at all that prices will go down. They might moderate, but even the Fed chairman himself said prices will not reverse. And what do we have right now? We have the COVID-19 shutdowns in China. They're shutting down ports, which will increase shipping costs. So this could be the beginning of a massive stagflation storm in the economy. The consumer stops buying, the economic activities go down, the pace of employment slows down, while prices continue to surge higher. This is the biggest risk for the economy, by the way. Stagflation. It's not fun. It will leave a scar that will last forever on the American economy, perhaps the global economy. In addition to shipping prices going higher, we also have the producer price index, which we discussed in the last video, soaring 7.8% annually in July. And this is the highest reading on record. Folks, the Fed is stuck between a rock and a hard place. What do you do now with this information? On one hand, you have inflation surging beyond control, which merits tapering. But you know in the back of your head that tapering will crash the market, and crashing the market will spill over into the economy, perhaps crashing the economy altogether. On the other hand, you have Delta, and you have the demand side of the equation perhaps slowing down as consumer sentiment crashes. So the Fed is saying perhaps we don't need to taper because inflation will cool down on its own. This is the assumption. Yet going on with this assumption and delaying tapering in hope that the consumer sentiment crash will slow down demand and inflation will slow down is playing Russian roulette because there is no guarantee at all that prices will go down. We have shutdowns at ports in China, increasing shipping costs even higher. We have droughts, extreme weather all over the place, causing shortages in grains, meats, and crops. Commodity prices are rising higher as we see labor shortages, Delta shutdowns across the world, increasing the cost of extracting these raw materials for production to begin with. So there are no guarantees here that prices will go down. The Fed is in a massive dilemma. Do you taper, take the risk of crashing this economy and the market, or do you wait and risk the phenomena of stagflation? And this leads us to this interview I was watching on Bloomberg with Mohamed El-Erian, and they were talking about Fed presidents and where they stand in the tapering discussion. We have the we're not there yet, we're not going to taper, we're not even thinking about talking about tapering. These are Jerome Powell, brain dead, Williams, Evans, and Kashkari. Now, you're going to play this game because perhaps you want to be Fed chair and you want to keep your chances of becoming Fed chair alive by pleasing Wall Street. So naturally, we have Powell. And then we have brain dead, she's a woman, and a favorite contender to follow Jerome Powell. And then we have Kashkari, I guess he's Asian American, so he has a shot. What about Williams and Evans? Perhaps they're thinking about becoming trans, and that will give them a shot in becoming Fed chair. Then we have the camp that says perhaps we should announce this fall, talking about tapering, of course. We have Clarida, Daly, Boystick, Barkin, George, Rosengren, and it is a bit surprising here. Boystick and Daly should be in the camp that says we're not going to taper, we're not there yet. And Williams and Evans should be in this camp that we should announce tapering this fall. Williams, Evans, you got zero chance, zero, of becoming the next Fed chair. Boystick and Daly have a shot. And what about the ones who say that we should be tapering now? We have Waller, Kaplan, Bullard, and Harker. And the only voting member out of all of these is Waller. So these people have no interest at all in becoming the next Fed chairman. And they also have no interest at all in becoming trans. But what really caught my attention is, in the mid of the interview with Mohamed El-Erian, they talked about a slip, a nuclear slip by a certain Fed president who I believe watches this channel and listening to what we've been saying all along, that the Fed's cocaine operation of propping up the stock market and real estate values by buying $120 billion every month in bonds and mortgage-backed securities have zero correlation with creating any job. And the only correlation that the cocaine operation has is with inflation and increasing asset prices. Let's see if you can catch what I'm talking about here.
Mohammed, something slipped under the radar for a lot of people this week. You were on top of it. It were the words of Boston Fed President Eric Rosengren. And I want to bring you the quote for our audience, and it read as follows. This was with the Associated Press. If you continue to purchase assets, the reaction primarily is in prices, not so much employment. I don't think asset purchases are having the desired impact on really promoting employment. Mohammed, this is really rare for someone on the Federal Reserve to question the value of QE.
And here it is, Rosengren pretty much negating the entire purpose of the Fed. What are you doing here, Mr. Rosengren? Would you like to sleep with the fishes? This is suicidal. This is pretty much him saying, yeah, we know. This charade, this facade of buying assets all over the place, $120 billion minimum every month, has nothing to do with creating jobs. The only thing we're achieving with this is higher inflation and creating asset bubbles in the equities and real estate markets. What happened to you here, Mr. Rosengren? You lost your mind. That's what happened. Gotta watch your back from this point on. And of course, the market did not care at all. This is a massive statement. The man is negating the entire purpose, the entire so-called mandate of the Federal Reserve. And the market did not even care. This is a coked up market, hooked up on drugs, a zombified market that will only wake up in a rude awakening.
That's different.
It is, and I tweeted it out because President Rosengren in particular is highly respected for being for saying it as it is. He comes from a research background, and he has a very direct communication style. And for him to say QE simply works on asset prices, doesn't work on the economy, is a big statement. But as you said, it flew totally under the radar. And it just shows you the conditioning of this market. This market is so deeply conditioned to believe two things: that the Fed is going to be our friend forever. I call it the BFF. And secondly, that there is no alternative, as you started out our interview, that we will brush aside as a marketplace until there's overwhelming evidence. And the question is, what does that overwhelming evidence look like and when does it come? And I don't know a single person who can answer that question confidently.
And of course, Mohammed asks, what would it take? What will happen? What will be the evidence for the market to finally realize that the party, the so-called game, is coming to an end? What will it take? I have the answer, Mohammed. The answer is when the overlords over at Wall Street, the 1%, they grab the phone, they call Powell and say, you know what? We've made billions and billions, if not trillions of dollars during this massive orgy, this massive bubble that you guys have created. Thank you so much. But now asset prices are too high. We've already cashed in. We'd like to leave the retail dummies holding the bag, crashing the stock market, real estate values, so we can buy them cheaper. So, Mr. Powell, you have the go-ahead, the blessings of the 1%, the ruling class of this country, to start tapering and tightening the monetary policy. Then the Fed will not hesitate at all to start tapering and raising interest rates. And while we're at it, let's try and call Mr. Eric Rosenberg of the Boston Fed and see what he has to say about all of this.
You kids were right about us. You know how many jobs the Fed created in the last 10 years since we started pushing drugs into the market? Zero. Fucking zero.
Oh, wow. I didn't know that.
And you were asking me why I'm talking about this right now. I'll tell you why. Well, I'm not black. I'm not Hispanic. I'm not a woman. I'm not gay. 100% sure about that one. So I got no chance in becoming Fed chairman. So I decided to retire and tell the truth.
So what are you going to do now, Mr. Rosengren?
Oh, I'm just going to open a weed store. Anyways, this is all I wanted to talk to you about today. I got to go wash my car. So you take care, okay? And, fuck the Fed.
All right, here it is. Mr. Rosengren, everybody. Now let's move on and cover some charts, shall we? Starting with the SPY 30 minutes chart. What do we see here? It has been a consolidation range that has been broken to the upside. And now, looking at the chart, there is nothing wrong with it at all. It's a breakout, a slow grind higher. And the sky is the limit here. You have no reversal signal. We have nothing at all but to ride this wave of the SPY breaking higher. So why am I skeptical about all of this? Because when we shift to the daily chart of the continuous contract on the SPY, again trading at all-time highs, breaking the consolidation range, reversing the negative divergence on the RSI, and therefore I removed the thumbs down. And now watch. Now that I removed the thumbs down, the market will crash on Monday, guaranteed. But all jokes aside, why am I still skeptical about this rally, this breakout higher in the SPY? Look at the volume and look at the internals of the market. The market is acting as a headless chicken, shifting from one side to the other every single day. One day it is the inflation side, the other it is the tech growth, momentum, stay-at-home side, depending on what the bond market is doing. This tells me that the market has a lack of conviction in the move higher, and therefore I remain hesitant and unconvinced about this breakout higher in the SPY. What about the Qs 30 minutes chart? We're using a line chart here to track the bullish channel of trading. We have defined peaks and defined valleys. Now the chart briefly broke below the trading channel, but it managed to climb and crawl its way higher back into the channel above the support line of 365.5. So with this behavior, it shows the resiliency, quote-unquote resiliency in this market, refusing to go down. Nazal Arian said, what would it take for the market to finally be convinced? What piece of evidence will it take for the market to be finally convinced that the party is coming to an end? I believe this will come out of the blue. The so-called advance warning is not going to happen. Nothing wrong with the chart here. Nothing at all. The chart remains bullish. What about the daily chart, the continuous contract on the Qs? Again, we have a slightly less positive chart than the SPY. The SPY is breaking higher. The Qs is still within the trading range. We have a resistance, a defined one, almost a double top. Will the Qs stop at that level again? We'll see. But for now, it is still trading above the last support line of 15,000, almost at all-time highs. The difference between the SPY and the Qs is that the negative divergence in the RSI is still here, and the negative momentum in the MACD indicator is also still here. Likewise, we're still battling in the bond market, weighing in the PPI indicating higher inflation versus the crash in consumer sentiment indicating that perhaps inflation will slow down. As we debate these issues, the Qs continues to go back and forth, and therefore I'm keeping the thumbs down on this chart. What about the IWM 30 minutes chart? We have a defined range now, 218 as support, bouncing over and over and over and over again from that level. And then we have 223 as resistance, going over and over and over again, trying to break above that level with no success at all. Now, we saw a flush down on Friday for the IWM, underperforming the market in general, and the reason is the IWM is an offensive ETF in the market. What does that mean? It means if you are optimistic about the economy, the pace of growth, the pace of spending, the consumer sentiment, you buy the IWM. It includes offensive names in the market, specifically some reopening names. What do we got? On Friday, we got the Consumer Sentiment Index crashing, and therefore the IWM hitting the brakes and moving away from the resistance. For now, as a trader, there's nothing you can do here. If you follow the Consumer Sentiment Index and you ignore the PPI, for example, you could be buying a put trade, a bearish trade here, betting that the IWM will go down all the way to the support level of 218. But for me, I'm not doing anything at all until a breakout happens one way or the other. Above 223, that will be bullish, meriting me to buy calls, or below 218, that will be bearish, meriting me to buy some puts on the IWM. What about the Dixie? Massive collapse on Friday, big one. And the reason is, once again, the Consumer Sentiment Index. You guys heard the man from the University of Michigan saying that perhaps the decline in consumer sentiment will be translated in less spending and therefore reducing the demand side of the supply-demand demand dynamic and therefore reducing inflation expectations and reducing the pace. That's what really matters for the Fed, the pace of price increases. If that is the case, then the Fed need not to taper because tapering is more risky now. You have consumer sentiment crashing, we have Delta, we have a lot of uncertainty. Why would you taper now and not delay and kick the can down the road? At least this is what the market is saying on Friday. We will see if we have a follow-up on this action or not, but this is what the market said on Friday. Tapering will be delayed and therefore the value of the US dollar goes down as we see more printing and more cocaine in the market. And this, of course, has been good for the chart of gold. Gold rising higher, now trading above the threshold of 1,750, above the Fibonacci retracement level. The real test will be around 1800. That will be a massive resistance here. But once again, my question to the gold bugs, the Peter Schiffs and the likes. You say that gold is a hedge against inflation, and indeed it was in the 1970s. But now, for now, from the data we have right now, gold has been trading higher when inflation expectations go down. Gold has been trading in an inverse relationship with yields. And we see gold popping higher on Friday as the consumer sentiment crashes. What does that say? Is gold really a hedge against inflation? Or is it trading as a tech company, an equivalent of the Nasdaq index, rising higher when yields go down, the dollar crashes, or when inflation expectations go down? Let me know the answer. And here it is, the chart of the 10-year Treasury yield, facing the resistance of the descending line, the descending slope, and now it is back at the support of 1.28%. This is the real test, by the way. And we will see the action happening overnight, perhaps as you're listening to this video right now. Watching, listening, doesn't matter to me, because we've been tracking the Asian investor sentiment, and it has been negative all along. They've been buying US bonds, they've been buying the US dollar, and therefore pushing yields down overnight. On the other hand, the American investor has been optimistic so far. Yes, we have Delta challenges, but we have about 80% of the country already vaccinated. So this is not going to be a problem that merits shutdowns and slowing down of the economic activities and economic growth. And therefore, you see yields going down overnight and then rebounding higher as trading starts here in the United States. My question to you was, will at some point the US investor also become bearish on the economic outlook and they start buying bonds along with the Asian investor? And if that is the case, then yields will drop big, perhaps breaching the 1% threshold. We will see. Once again, it is a battle between the data we get from the PPI, the CPI, versus the Consumer Sentiment Index. We have a lot more data to go over this week, from retail sales to the Chicago PMI. So it's going to be a freak show in the bond market. Make sure you grab your popcorn and watch the shit show. TLT weekly chart. We have the reversal of the reversal. And now the TLT pretty much giving us nothing at all. Just consolidating in or around the important line of resistance of 149. Now, it depends on what side you're on, the Consumer Sentiment Index or the PPI. If you are in the side of the Consumer Sentiment Index as the leading indicator, then perhaps the sentiment among US investors will mirror the sentiment from Asian investors, and they will stampede to buy bonds for quote-unquote safety. We will see the TLT blasting higher as yields crash. On the other hand, if you believe the PPI side, and perhaps more data, let's say the Chicago PMI, also indicating that prices will continue to go higher, then perhaps yields will rebound higher and the TLT will start trending down once again. It's a battle, very interesting to watch. About the VIX, what's going on here? The VIX has been melting down as the SPY melts higher, grinds higher, slowly but surely on low volume. Now the VIX is about to close the gap at around 15. We've been waiting and waiting and waiting for the third pop, an attempt to crack above 20. Could it happen this week? Who knows? Yet the risk versus reward says the VIX will pop higher. It is becoming oversold right now, and it needs to pop higher. Look at the MACD indicator. We have a pop imminent because the MACD indicator is bottoming from a 4 hours perspective. Perhaps a pullback in the SPY. It could be a big one. We have no clue. That will come hand in hand with a pop in the VIX. Understand this. If the consumer sentiment data is pointing to inflation easing because consumers had it and they're not spending anymore, or at least this is what they're saying regarding sentiment, then the inflationary trade, the reopening trade, will suffer. And this is a huge block of the SPY. Now, what if technology doesn't cooperate and it stays muted or trading down? Then the rational conclusion is the SPY will start to melt down, perhaps flush down, and the VIX will pop higher. The risk versus reward says the VIX will pop higher, SPY will push the brakes. What about Apple? What's going on here? This is, by the way, for me at least, the leading indicator in the market. Everybody's all over the place. The macroeconomics data all over the place. The sentiment all over the place. The charts all over the place. But Apple has been consistent within a trading range. Support at 145, resistance at 150. On Friday, the name popped higher, and now it is inching closer to break above 150. Looking at the chart right now, if you had to place a bet one way or the other, will the chart of Apple break below 145 or above 150? The rational bet will be Apple will break above 150. What does that mean? It means technology, perhaps big cap technology at least, will start to outperform this upcoming week. This is of course all going on the heels of the consumer sentiment data we got on Friday. If we get more data negating the consumer sentiment, say from the Chicago PMI, retail sales, then the rally in technology or the pop in technology, specifically Apple, will cool down and perhaps fall back within range 145 and 150. And the main question here is, what do you trust? How do you trade? The answer is you don't trade unless you want to get whacked. And the reason is you could look at this chart and say, okay, I'm buying the 150 calls for Apple. It works on Monday, Apple pops higher. And then Tuesday we get retail sales and the number comes out hot, perhaps saying that the consumer sentiment is negative. But the action from the consumer is not following the sentiment, meaning that consumers say it's not the right time to buy, but they're buying anyways. And then Apple goes down. You have no clue how to trade here. It's extremely risky. We have no clarity. And the rational way of action this week is no action. Wait for clarity. Perhaps Wednesday we're going to get more clarity after retail sales data is out. What about Tesla? What's going on here? Tesla broke above 720 briefly before reversing and closing the week below 720. Is it a problem? Not at all. The chart remains bullish, and the likelihood is that Tesla will break above 720. Again, if we have a problem in the market in general, Tesla will go down. It's not going to be the only survivor here. But looking at the technicals alone, looking at the action of the bond market on Friday, the risk versus reward says you buy Tesla calls. In addition, the implied volatility in the name remains extremely low from a historical perspective. The risk versus reward once again says buy Tesla calls. The technicals are good. The implied volatility is good, indicating that premiums are cheap right now. And the action in the bond market so far on Friday is favorable for names like Tesla, the high growth, high momentum names to rise higher. Again, no guarantees here. The market is trading in murky waters with no clarity. But if you had to bet, you'll bet that Tesla will go higher. I know you guys want the tickers and you want to gamble, so I'm satisfying your degenerate gambling needs. Tulips, BTC, what's going on here? We talked about the RSI having a saucer topping formation, which means that the action will slow down. But it doesn't mean that the positive sentiment and the rally in BTC will stop. Matter of fact, it will go on to complete the C leg. At around 50,000, that will be the resistance, and perhaps we will look for a pullback at that point. Let's talk about Doge. We haven't talked about Doge for a while. If you bought the pop after the rescue operation number 4 by Dorsey, Musk and Wood, you should be looking at 35 cents as exit point number 1, perhaps taking 50% of the gains off the table. And then the ultimate resistance at 45 cents, that will be exit point number 2, where you take the other half. And now you've made a killing. You bought Doge at 21 cents, you sold it at 35 or even 45. Not a bad return at all. What about AMC? What's going on here? The good news is that the apes managed to defend 32 as support. Very impressive. The daily chart remains okay. The daily chart perhaps indicating that the chart is bottoming. Look at the MACD indicator. Look at the RSI indicator. Saucer bottoming and working its way higher. The implied volatility is also rising a little higher, perhaps indicating that in the short term, AMC could pop higher. The problem with this stock is when we switch to the weekly chart, We got a problem here. The MACD indicator already topped and now crossing to negative territory. The RSI is weakening with negative divergence, and the likely outcome is, in the next few weeks, this chart will flush down. That's a nice way to say crash. So in the daily chart perspective, the short term, we could see a pop higher, and you could see a week or two, maybe 3 weeks of green candles, and then we see the flush down in upcoming weeks. So trade accordingly. Short term okay, long term not okay. Lastly, I want to share the sticker with you, the chart of SESN. Who the hell knows what this company even is? But my father-in-law called me today and he said that he holds this stock. On Friday, as the market closed, he checks his portfolio, specifically in this stock, and he's down about 50% or more. What happened here? The stock was trading fine, just fine, trading higher, matter of fact. And then in the last hour of the day, the stock crashed over 80%, almost 90% in an instant before rebounding higher by over 170%. Total insanity. So what happened here? What happened is, in the last hour of the day, the FDA decided to issue a negative recommendation for an upcoming drug from this company. The rally in this stock to begin with was based on the potential of an FDA approval of this drug. When the FDA decided to come out during the last hour of trading on Friday, by the way, and issue a negative commentary about the upcoming drug from this company, immediately the stock crashed right away, leaving investors with little time to react here, which makes it extremely weird. Why would the FDA issue a statement that they know will move this stock significantly higher or lower in this case during the last hour on Friday's trading session? Anyhow, the stock drops big. Immediately, notice the volume here. The volume did not increase on the downside, meaning that the algos dropped the stock down, leaving investors with very little time to react. Matter of fact, they did not react at all. Shorts reacted by booking gains, covering their shorts and buying the stock, gaining on the downside, and now gaining on the upside when they covered the short, scoring about 170% gains. So they scored on the downside from shorting the stock, and of course they're watching and watching and watching because they're invested in this stock, that it will drop after the FDA announcement. Indeed it did. Now they cover their shorts, they buy the stock, and they score big as the stock rebounds. So where does the stock goes from here? Let's read the psychology first. The psychology says longs did not have the time to react at all on Friday. For example, my father-in-law was out. He couldn't even trade even if he wanted to. Meanwhile, the shorts had an opportunity to react, and they did by covering their shorts and booking gains on the upside. Now, what happens after hours? Shorts made a killing on the downside and the upside. In the aftermarket, they dumped the stock again to book their gains all together, and therefore the stock is trading about 17% on the downside after hours. We have not seen the reaction of longs, so when trading opens on Monday, the assumption is the stock will open down as shorts book some profits. The ones who actually managed to cover their shorts on Friday. But as the trading session starts, we will see other shorts who did not book profits on Friday booking profits by buying the stock. In addition, after a massive drop like this one, put yourself in the shoes of longs. Would you abandon the trade now that you're down already over 50%? You got nothing to lose here. You're not going to abandon the trade at all. You're already down over 50%. What you're going to do is try to average down by buying the stock again at a cheaper price. If my outlook is right about the psychology, the stock will open down and then it will rebound higher. And this leaves us with an opportunity for an options trade in this one, specifically buying calls, perhaps intraday, meaning you buy the call option in the morning and you dump it during the same day as the stock rebounds. Now, here's a daily chart of the action in this stock. Again, the ticker is SESN, N as in Nancy. The support at $2.06. If it dips below that number in the morning, the assumption is we will see a lot of buying, and I will be watching this level. If it holds and the stock starts to trade higher, that will be a confirmation to initiate the call options trade. However, if the stock fails to trade above $2.06 a piece, get rejected, trade to the downside, then we don't have a trade here because we will see more pain in the name. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar this upcoming week? Monday, we have the Empire State Manufacturing Index, an important pulse regarding inflation. We're watching prices paid. Tuesday, we have retail sales. This will be an important number. Will it be a confirmation of the Consumer Sentiment Index? Remember, that reading was quote-unquote preliminary, so watch out for the trap here. If retail sales come out hot, the number will negate the Consumer Sentiment Index we got on Friday. On Wednesday, another one, an important day, we have housing starts and then the FOMC minutes. Thursday, we have, per usual, the initial jobless claims, and then we have the Philly Fed Manufacturing Index. Again, it is the battle between inflation and deflation. The battle between the PPI, the Empire State Index, the Philly Manufacturing Index versus consumer sentiment and retail sales. The Empire State and the Philly Manufacturing Indices have to come out supporting the data we got from the PPI for yields to pop higher and the inflationary trade to outperform. On the other hand, retail sales have to come out soft to support the University of Michigan Consumer Sentiment Index that we got on Friday. If that happens, then yields will drop down, TLT bonds will pop higher, the Dixie will go down as tapering expectations get pushed further down the road. Now, what happens if either one of these comes out negating the previous data we got from last week? Say the Empire State or the Philly Manufacturing Index negate the PPI, while retail sales confirm the data we got from the University of Michigan regarding consumer sentiment. Now we have a confirmation that yes, the economy will slow down, the consumer sentiment has turned bearish. Oh, and we have evidence that this is not just talk by consumers. They're actually putting their money where their mouth is, and they're not spending on retail. Another scenario, the inflationary scenario, the tapering scenario. Let's say the Empire State Index comes out hot. Prices paid rising significantly higher. And then we have a hot retail sales data, or perhaps the retail sales number negates the University of Michigan Consumer Index, Consumer Sentiment Index. And yields will pop higher, and now we have a confirmation. Forget about the Consumer Sentiment Index. That was a preliminary reading. We're on track. Inflation is rising higher, and the Fed will taper sooner than expectations. Dixie pop higher, gold goes down, you know the story. Anyhow, folks, interesting week. Thank you for watching. Thank you for listening. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.